It's literally a tale of two completely different economies. On one hand, we're witnessing this historic AI-fueled tech rally on Wall Street that is just minting billions. But on the other hand, everyday borrowing costs for Main Street are tightening their grip, creating some real, tangible pain in the housing market. It's two entirely different realities playing out at the exact same time, and today, we're going to break down the numbers behind both. Okay, let's quickly run through our agenda. First, we'll hit the record-breaking tech rally. Next, we're looking under Microsoft's financial hood, followed by mapping the stock chart. Then, we pivot to consumers with the Main Street mortgage squeeze, and finally, high yields and stalling housing. Let's jump right into part one, the record-breaking tech rally. So this is where the sheer, undeniable scale of the current AI boom really comes into focus. To put the magnitude of this into perspective, Microsoft just saw its stock jump an incredible 15.5%, closing near $451.50 a share. That is their absolute best single-day percentage gain since way back in October 2008. And look at what this actually means for their footprint. This rally pushed their total valuation to a massive $3.35 trillion. Plus, a huge piece of this puzzle, their annual Azure revenue just crossed the $100 billion mark for the very first time. On the software side, Microsoft 365 Copilot has now surpassed 30 million paid seats. But what's absolutely fascinating here is that their stellar cloud results completely offset their heavy AI spending. Actually, with management projecting Azure growth around 45%, it tells us something pretty crazy. The demand for AI computing is actually outstripping Microsoft's available capacity to provide it. Moving right along to Section 2, under Microsoft's financial hood. To truly grasp why Wall Street is so euphoric right now, we really need to look closely at the hard numbers driving their fiscal fourth quarter results. And wow, it is remarkable how clean these beats are across the board. Revenue hit $90 billion, up 18% year over year. Net income surged 31% to $35.8 billion. And diluted earnings per share, that jumped 32% to $4.81. You have to remember, these aren't just minor incremental beats. These are massive double-digit growth figures for a company that's already valued in the trillions. It gave investors a crystal-clear, fundamental reason to aggressively buy the stock. But, beneath those huge headline numbers, there is a clear divergence happening inside the company itself. We're seeing soaring cloud revenue directly contrasting with slumping hardware. While Azure and other cloud services revenue skyrocketed by 43%, the older legacy segments really struggled. Windows OEM dropped 7%, and Xbox content and services fell by 10%. So it paints a super clear picture for us. AI and cloud infrastructure have become the undisputed growth engines carrying the whole shebang right now. And to keep those exact engines roaring, well, they are spending heavily, $175 billion. That is Microsoft's adjusted calendar year estimate for capital spending. I mean, that is a number larger than the GDP of many entire countries. It's just an enormous sum of money, and it proves that management is keeping their foot firmly on the gas. They are spending whatever it takes to build out this future infrastructure and maintain their AI dominance. All right, let's get into Section 3, mapping the stock chart. Now that we've got a handle on the fundamentals, let's treat the stock chart like a battlefield of investor expectations. Following the release, the stock gapped aggressively from the low 390s straight up to an intraday high of $458.57. That leaves a massive open space on the chart. What this means, technically, is that the $460 mark is now a major resistance level, a psychological ceiling that's going to be really tough to break. And all that empty space below? Well, that creates significant retracement risk. When we see a sudden double-digit move like this, it very often invites profit-taking as the initial euphoria sort of cools off. Then we have the battle of the moving averages. This earnings surge allowed Microsoft to decisively reclaim its victorious 200-day simple moving average, which currently sits at $433.80. Meanwhile, the 50-day and 20-day averages are still lagging way behind, down in the 390s. So the really crucial point here is that holding above that $433.80 average strongly supports the narrative that this rally has fundamentally changed Microsoft's broader trend. If it falls back below that 200-day line, though, the bearish retracement risk goes up significantly. So, big tech is absolutely booming. They're minting billions and breaking all-time records. But what about borrowing on Main Street? Let's step away from the Wall Street euphoria for a moment. Let's just take a breath and look at the everyday financial reality facing normal consumers. Because as you'll see, the picture there is vastly different. This brings us to Section 4, the Main Street mortgage squeeze. While tech stocks are practically going to the moon, prospective U.S. homebuyers are feeling the very real pain of a fourth consecutive week of rising mortgage rates. Let's walk through this timeline to see exactly how we got here. Back in July 2025, the 30-year average was sitting at 6.72%. By February 2026, buyers finally got a little bit of breathing room when rates dipped just under 6%. But man, that relief completely vanished. By July 23, 2026, rates were back up to 6.58%. And just one single week later, on July 30th, they hit 6.66%. We are pushing right back up against one-year highs, entirely erasing that winter dip. And here is exactly what that means for the average person's wallet. Say you're looking at a standard $400,000 mortgage. That rate jump from 6.58% to 6.66% in a single week pushes your monthly principal and interest payment from $25.49 up to $25.71. That's a $22 increase in just 7 days. And remember, that excludes property taxes, insurance, and fees. This continuous, relentless squeeze on affordability is exactly why total mortgage applications just took a 6.4% nosedive. People are quite literally stepping back and being priced out of the market week by week. Which leads us right into our final section, high yields and stalling housing. To see how this all builds together, we really have to zoom out to the macro level. The Federal Reserve recently decided to hold their federal funds target range steady at 3.5% to 3.75%. Interestingly enough, it was a divided 9-3 vote, with 3 policymakers actually favoring an interest rate increase. The Fed's reasoning? Well, inflation remains stubbornly above their 2% goal, which they note is largely being driven by lingering supply shocks and higher energy prices. Their tight, unyielding grip on the economy to fight this inflation is precisely what is keeping the cost of borrowing so incredibly elevated for the rest of us. And this next chart brilliantly illustrates the real culprit for homebuyers. See, mortgage lenders don't just look at the Fed's overnight rate, they actually price home loans based on long-term bond markets, specifically the 10-year Treasury yield. Notice the steady climb here. At the start of July, the yield was 4.48%. By July 30th, it had steadily climbed to 4.68%. As long as those long-term Treasury yields stay high, consumer mortgage rates are going to stay painfully high right alongside them. Which brings us to the ultimate question I want to leave you with today. We are looking at a massive structural divergence in our economy. Will AI-driven corporate growth continue to basically defy gravity and outpace the heavy anchor of high interest rates? Wall Street is celebrating an unprecedented tech boom, while Main Street is literally buckling under everyday borrowing costs. Can these two completely distinct realities stay disconnected forever, or will something eventually have to give? It is an absolutely fascinating dynamic to watch unfold.